Today's discussion centers around the Westwood Salient Enhanced Midstream Income ETF, a relatively new player in the market. It promises high income and capital appreciation, but how realistic is that claim?
The promise is certainly enticing, and the fund structure is designed to deliver on that promise. However, like any investment, it carries inherent risks that need careful consideration.
Right, and those risks are significant given its focus on the energy sector and the use of option strategies. Let's dive into the investment strategy itself.
The fund employs a multi-pronged approach. It invests primarily in midstream energy companies in the U.S. and Canada, a sector known for its relatively stable cash flows.
So stable cash flows are the foundation, but the enhanced part of the name suggests something more. What's the secret sauce?
The enhancement comes from a disciplined options overlay strategy. The investment team actively sells out of the money call options on the underlying equity holdings.
Selling call options generates income, right? But it also caps potential upside gains, doesn't it?
Precisely. It's a trade-off. The team prioritizes consistent monthly income generation, accepting a limit on potential upside in exchange for a more predictable income stream. This is a key element of the fund's income-focused objective.
And this strategy is applied to a portfolio of carefully selected midstream energy companies. What's the rationale behind that sector choice?
Midstream energy offers a compelling combination of relatively stable cash flows and attractive growth potential. These companies are less susceptible to the volatility of commodity prices compared to upstream producers.
So it's a bet on the infrastructure rather than the price of oil or gas itself. That makes sense. But what about diversification?
The portfolio is diversified across several major midstream companies, reducing the risk associated with any single holding. However, the concentration in the energy sector remains a significant risk factor.
Let's talk about the team managing this fund. The fact sheet highlights a long-tenured team with significant experience. How important is that?
Experience and a proven process are crucial in active management. The team's long tenure suggests a consistent approach and a deep understanding of the midstream energy sector. Their experience in managing a substantial amount of assets is also a positive indicator.
The materials mention a fundamental research-driven portfolio construction process. Can you elaborate on that?
The team conducts thorough fundamental analysis of each potential investment, focusing on factors like cash flow, debt levels, and management quality. This bottom-up approach aims to identify undervalued companies with sustainable income streams.
So it's not just about picking energy companies, it's about picking the right ones based on rigorous research. What about the tax implications?
The fund aims to be tax efficient, potentially utilizing tax loss harvesting strategies to offset gains. The ETF structure itself can also offer tax advantages compared to other investment vehicles.
Now, let's address the elephant in the room, risk. The fund's prospectus clearly outlines several key risks. Let's start with the covered call strategy.
The covered call strategy, while generating income, limits upside potential. If the underlying stocks outperform expectations, the fund will miss out on some of those gains.
And what about counterparty risk?
Counterparty risk is the risk that the buyer of the options might default on their obligations. This is a relatively low risk in the context of established options exchanges, but it's still a factor to consider.
The prospectus also mentions portfolio turnover risk. What does that mean in this context?
High portfolio turnover can lead to increased transaction costs and potential capital gains taxes. The fund's strategy involves active management, so some level of turnover is expected, but the team aims to manage this risk effectively.
Beyond the options strategy, there's the inherent risk of investing in the energy sector.
Yes, the energy sector is cyclical and subject to various factors, including commodity price fluctuations, regulatory changes, and geopolitical events. These risks can significantly impact the fund's performance.
Finally, the NLP component. What are the specific risks associated with master limited partnerships?
MLPs have unique tax structures that can be advantageous, but they also carry specific risks. Changes in tax laws or a loss of their partnership status could negatively impact distributions. They can also be less liquid than other securities.
Let's look at the performance data. The fact sheet shows positive year-to-date returns, but past performance is not indicative of future results.
Absolutely. The provided performance data is just a snapshot in time. Investors should not rely solely on past performance when making investment decisions. The fund is relatively new, so its long-term track record is still limited.
The distribution history shows consistent monthly distributions, but it's important to note that these distributions may include a return of capital.
That's a crucial point. A return of capital reduces the fund's net asset value over time. While it provides income, it doesn't represent actual earnings and can lead to a reduction in the overall value of the investment.
The 30-day SEC yield is also a key metric. What does that tell us?
The SEC yield provides a standardized measure of the fund's income generation over a 30-day period. It helps investors compare the fund to other similar investments. However, it's just one factor to consider, and it doesn't reflect the total return, which includes both income and capital appreciation.
The fund fact sheet provides a concise overview of key characteristics including the expense ratio, distribution frequency, and ticker symbol. What are some of the key takeaways from this information?
The expense ratio of 0.80% is relatively standard for actively managed ETFs. The monthly distribution frequency aligns with the fund's income-focused strategy. The ticker symbol, MDST, is easy to remember and track.
The asset allocation shows a significant portion invested in MLPs and C-Corp. What does this tell us about the fund's risk profile?
The significant allocation to MLPs reinforces the fund's focus on the midstream energy sector and highlights the associated risks. The inclusion of C-Corp provides some diversification, but the overall concentration in energy remains a key risk factor.
This sector composition further breaks down the holdings within the energy sector. What are the main sectors represented?
The fund's holdings are spread across various midstream subsectors, including natural gas pipelines, gathering and processing, and crude and refined products. This diversification within the energy sector aims to mitigate some of the risks associated with a concentrated sector allocation.
How would this ETF fit into a broader investment portfolio?
This ETF could be a suitable addition for investors seeking a higher than average income stream with a moderate risk tolerance. It could serve as a complement to other asset classes, providing diversification and potentially enhancing overall portfolio yield. However, its concentration in the energy sector and the use of option strategies should be carefully considered within the context of a well-diversified portfolio.
What types of investors might find this ETF particularly appealing?
Investors seeking monthly income, exposure to the energy infrastructure sector, and a potential alternative to high-yield bonds or REITs might find this ETF attractive. However, it's crucial to remember that the fund is not without risk, and investors should carefully assess their risk tolerance before investing.
The materials repeatedly emphasize the importance of reading the prospectus before investing. Why is that so crucial?
The prospectus provides a comprehensive overview of the fund's investment objectives, strategies, risks, and expenses. It's essential reading for any potential investor to make an informed decision.
And finally, a reminder that past performance is not indicative of future results.
This is a fundamental principle of investing. While past performance can be informative, it's not a guarantee of future returns. Investors should always consider the fund's risk profile and their own investment goals before making any investment decisions.
So the Westwood Salient and Trans Midstream Income ETF offers a potentially attractive combination of income and growth, but it's not without significant risks. The fund's strategy, while aiming for consistent income, involves a trade-off in terms of potential upside. Thorough due diligence and a careful assessment of one's risk tolerance are essential before investing.
Precisely. Investors should carefully consider their investment objectives, risk tolerance, and the fund's specific risks before making any investment decisions. The prospectus provides the necessary information to make an informed choice.
That was a great discussion. Thank you for your insights.